Taking control of your personal finances, becoming wealthy, becoming a successful property investor is simple, but it's not easy. And that's not a play on words. It's simple if you know how, but it's not easy because a lot of investors make mistakes. They're fussed about the price they're going to pay for their property. They're fussed about the timing, when maybe neither of those matters as much as you think. In fact, that's the topic of today's chat with Stuart Wemyss, who's going to explain that it's what you buy, not when you buy, that matters the most. We're going to talk about some numbers and figures, and if you're not a numbers person, that's okay, because the big picture message Stuart's going to give is very, very important. We're also going to talk about what makes an investment grade property, what characteristics it needs, and a bit about the world of finance at the moment, which is changing in front of our eyes. And in today's mindset message, I'm going to share with you some of my thoughts about failure. And yes, we all fail at times in different areas of our life, but it's not a bigger deal as you think. So welcome to today's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator who has once again been voted Australia's leading property investment advisor. That's the fifth time he's won a similar award in the last 7 years.
How important is timing the property market? How important is getting the purchase price of your property when you look back 15, 20 years later and look at the performance of your property? Well, most people think they're critical, and maybe it's not as important as you think. Well, that's the opinion of leading finance strategist, best-selling author, and accountant financial planner, Stuart Wemyss, Director of Pro Solution Private Clients. Welcome, Stuart.
Hey, Michael. Great to be with you again.
Now, I read with interest your blog. In fact, to be honest, I was listening to your podcast about it, where you were suggesting it's what you buy that's much, much more important than when you buy that matters. But what I'm hearing from our clients at Metropole at the moment is, hey, I know it's good to buy a property. I know I should be buying now when others are a bit fearful. But they're wondering, is the timing right? And I know when they ask that, it's actually not the timing that they're worried about. It's really more, am I going to look stupid in 3 months' time if the property's worth $50,000 more? Or less, I should say.
Yeah, that's right. That's right. And I think ego has a lot to play in it. And I think we want to feel smart. You know, we all want to feel smart and reflect on our decisions and go, wow, that was perfect timing. I bought that stock just when it, just before it rose 100% or something like that. It makes us feel good. But really, at the end of the day, I believe in evidence-based strategies. And if there's overwhelming evidence that a particular factor or consideration is important, then absolutely it deserves our attention. But if the evidence suggests that it's not important, then what are we talking about? Is it just an emotional element rather than an actual statistical element? And if so, then we probably don't need to spend so much time on it.
I know that we discussed this in a previous podcast and in your blogs on your website and also on Property Update, where a couple of years ago, just before the federal election, you dug into what were the important factors in a property's performance. But you've recently revisited that again. And I like the way you do that because you're actually arguing with maths. You're talking about evidence as opposed to gut feel. So what did you look at this time, Stuart?
And I think that's a really important point, Michael, because when people come to you for property advice or they come to me for financial advice, a lot of people think that what they're doing is they're going to either of us and they have to trust Michael Yardley or they have to trust Stuart Wemyss. And that's actually not really true. I mean, obviously, there's an element of trust in giving advice. But if an advisor can't verify or substantiate why they're adopting a certain methodology, then I would say that my advice probably would be don't follow that advice. You don't actually have to trust me. You just have to trust the numbers or trust the evidence that I'm providing that supports, my thinking or methodology. And so that's why I redid these numbers, because I wanted to work out, for myself, before I did the numbers, I had a gut instinct of what it would tell me, but I didn't know the quantum, how big a difference does it make in the long run in terms of whether I buy above or below intrinsic value. And so part of that, there's two ways that you could probably do that, I guess. One is timing the market. If you're able to buy at a time when everyone's fearful and you get a property for below its intrinsic value, or buying well. Maybe if you're very astute and you look at hundreds of different property deals and you find the right one, maybe if you're really, really astute, how important is that? And that's why I wanted to do the numbers. So what I did is I looked at a couple of different scenarios: buying below intrinsic value, 5 to 10% below intrinsic value, and then overpaying. So that's kind of the idiot scenario where we've gone and bought either at the wrong time of the market or we've paid too much for the property. So again, 5 to 10% above. And then what I did is vary the capital growth rate. And I assumed we invested in a $750,000 property, borrowed the full cost, so didn't put any of our cash into it, kept it for 20 years, and then sold it. And then we paid for selling costs, we paid for capital gains tax, we repaid the loan. And then I measured what is the internal rate of return. So what is the compounding annual growth rate we've achieved from that investment, knowing that the only thing we've really contributed to the investment is the holding costs, the cash flow over the 20-year period. And I was conservative on the rental yield in terms of rental growth and so forth. And I held all the same assumptions constant except for the capital growth rate. And so
we'll talk about that in a second, but you've spoken about a lot of numbers. So what I just want to assure our listeners is that I'm going to put a link to your blog in the show notes. So let's talk about the general assumptions. And while I do want you to go into the figures, don't worry too much if you don't get all the figures that Stuart's talking about right now, because you can go and look at the detail later. Because really it's the big picture that's important, isn't it, Stuart?
Absolutely. And I'm an accountant and a nerd, Michael, so I get excited by the numbers. In any case, I varied the capital growth rate. And let's just talk about the either ends of the spectrum, because I looked at 3, 5, 7, and 9% average capital growth rate over that 20-year holding period. So let's just look at 3 and 9%, which is kind of either ends of the spectrum. So at 3%, the price that you pay for the property matters a lot. And the reason for that is that most of your return is going to come from buying well rather than the capital growth or the performance of the property itself. And it makes logical sense, right? That if I'm going to buy an asset that's going to give me a very low return, then I need to be really, really careful about how much I pay for that asset, because if I pay too much, that's really going to eat into my future returns. And if you're able to buy 10% below intrinsic value, it increased your return by 75%. And if you paid too much, it reduced your return by 77%. Now, they're big differences, right? But really, the return range between those two scenarios is between 1 and 7.5%. I mean, 1% return over 20 years, no one's going to get excited about something like that. And similarly, even 7% return when you've got a lot of gearing involved, again, is not a very considerable return. Now, if you compare that to the alternate option, which is buying a very high growth property at 9%, well, if you buy below intrinsic value, you increase your return by 10%. And if you overpay, you decrease your return by 8%. So not very sensitive to how much you pay for the property when you have a high-performing investment-grade property. And most importantly, the return ranges were between 20 and 25%. So, if I said to you, Michael, look, if whatever cash you contribute towards this investment, I'm going to give you a 20 to 25% return, I don't think you're going to care either way. And therefore, what I'd be saying to you is, whether you pay fair market value or 10% above, it's really not going to change your investment outcomes very much.
So when people say you make your money when you buy the property, they're right. But it's not because you buy cheaply. It's because you buy the right assets, Stuart.
Spot on. It's the quality of your investments that are going to determine your outcomes and determine your returns. And that would be true for property, but it's also true for any asset class, really. Logic stands that, you can't expect average or above average returns from a below average quality asset. It's the quality that's going to determine it. And, we often read quotes by Warren Buffett and so forth. And a lot of those quotes go to the quality of the business that he's investing in. I read one this morning, invest in a high quality business and then don't ever look at it for a very, very long time. he very much plays that long game. And it's the same with investing, and of course that also applies to investing in direct property. Quality is everything.
Well, we're going to talk about what the quality property is. And it's interesting, part of the reason I have fun chatting with you is because we have very similar philosophies about this, coming from a different area. My background really is more property. Yours is financial planning, accounting, numbers, providing finance strategies for clients. And we've come to similar conclusions. And I liked what I read when you said, you twisted one of Warren Buffett's good quotes. You said, I'd much prefer to buy a great property at a fair price than a fair property at a great price. He was talking about shares, but we're really saying the same thing, aren't we? That it's the growth of your asset, the capital growth. We both agree that cash is important to keep you in the game, but it's capital growth that's going to get you out of the game. So we've got to look for a property that's going to outperform with regard to capital growth. In your mind, then, how do you decide what's a high quality property?
Over the last 20 years, I've observed that there's really 3 attributes of a property that I think it needs to hold to be regarded as investment grade. And it needs to hold all 3 of those attributes as well. And there needs to be compelling evidence of those 3 attributes. And the 3 attributes are, you need a strong land value component. So more than 50% of the overall value of a property needs to be represented in its land value. And of course, an apartment can have an implied land value. You know, if you've got 8 apartments on a very valuable block of land, then just very quick and dirty, 1/8 of that value of the land is attributed to each apartment. So it's not true that apartments don't have a land value. Of course, if you're in a high rise and there's 300 apartments, well, then you've got to divide that land value by 300 and the land value is incredibly low. But you want more than 50%, and that's obvious because land appreciates and building depreciate over time. And really, as investors, if we're after capital growth, then appreciation is the only thing we're really interested in, and we need a strong land value component to do that. A property that doesn't have a strong land value component just won't have the capacity to be able to compete. I mean, it's a little bit like taking a Barina and trying to drive it in a Formula One race. It's just never, no matter, you can have the best driver in the world, but it just doesn't have the engine power to be able to compete in that race. So that's the first one, is land value component.
But not all land's created equal. So some people misinterpret this, and then they're going to go to the outer suburbs and buy a larger block of land. And we know that the inner and middle ring suburbs are going to probably keep growing at a faster pace than the outer suburbs. So I'd rather own 1/8 of a block of land under a good established block of apartments in a good inner ring, middle ring suburb of our capital cities than the whole hectare or multi-acre farm out in regional Australia, Stuart.
Perfect segue into the second characteristic, which is scarcity. And scarcity has 2 elements to it. Scarcity in terms of land and location. So you don't want to be buying in an area where there is really any land supply. That is, that you can't find any vacant blocks of land, maybe in 10 or 15 kilometre area from where you're investing. You want land supply to be fixed, and it's just not available. So if you go and buy in a new build area, of course, if you drive 5 minutes in either direction, you tend to find an abundance of land. You don't have scarcity in that situation. So scarcity in land location, and then you want scarcity in architectural style as well. I think probably the best examples might be, say, a block of Art Deco apartments. There might be sort of typically somewhere between 4 and 8 or 10 sometimes in a block, but no more. Versus if you think about a high-rise apartment, again, with 300 apartments in one building, they're the 2 either ends of the spectrum in the apartment world of scarcity. So you want that scarce element. And the whole point is, what you're trying to look for is not a diamond, because obviously diamonds are scarce and that's why they hold their value. You want the pink diamond. You want something a little bit extra, a little bit better, and you really don't want to make any compromises. As much as you possibly can, as much as your budget allows you to, don't make any compromises. The third element, Michael, is proven performance. I just don't understand why I would even consider investing in an area that I considered to be kind of the next growth suburb, if you like, that hasn't had any evidence of performing growth, but I'm going to take a punt. I'm going to take a view, and I'm going to put hundreds and thousands of dollars on that view and cross my fingers that hope I'm right. That's one option. Or the second option is, I can go and find a location and a type of property and an area where there's overwhelming evidence that it's provided very strong capital growth over the last 30 or 40 years. And I can point to the reasons what's driven that growth in terms of its locality and its amenities and the supply demand characteristics and so forth. So I can clearly see and articulate what's driven that growth. So when I contemplate buying a property, I would look at its past growth, and then I would also look at the past growth of very similar properties very close to it. And that will typically build a strong body of evidence to either demonstrate that I shouldn't be investing there, or in fact, it's a good investment. And again, this is really just employing evidence-based strategy. Why invest in an asset if it hasn't had the evidence of providing strong capital growth?
Now, we talk about capital growth rather than the physical growth of a suburb. So lots of new suburbs and outer areas are growing, and that's where the population is growing, but they don't have the scarcity that you mentioned. And the other thing is the nature of the dwelling or the sort of property that's being sold will often change over time. And so therefore, where there's a whole new estate and median prices in some of the outer suburbs have gone up over the last couple of years, it's because you're actually looking at a different type of asset than was being sold regularly before. So marketers can sometimes twist those figures, Stuart, to make it sound better than it is.
Yeah, I think median suburb data is next to useless. You know, if someone says, oh, this suburb has done 20% over the last 5 years, that means nothing to me. You really have to go back and have a look at the growth. And one of the disclaimers that are used in the share market is that past performance isn't indicative of future performance, which of course is true, and probably more true in the share market than it is in the property market. And the reason that I say that is that the things that drive growth in the property market tend to be static and factual. So static in that they don't change very much. And if they do change, they change over many decades. And factual because it's not a question of opinion. It's not subjective. You know, how much land is there available in the Melbourne suburb of Toorak, for example? That's a question of fact. What is the orientation of this land in terms of north-south? You know, that's a question of fact and so forth. So if I go back and have a look at the characteristics that have driven growth in Toorak versus a new build suburb, and then start to understand what's happened in that suburb, you know, that the original property that was sold, you know, there was just paddocks and they sold land for, you know, $150,000 per block. And then over the last 10 years, they've now got a Coles and a Woolworths and a doctor's surgery, and it started to develop and it's turned into a suburb. Now, if you extrapolate the growth over that 10-year period, you're probably very excited about the prospect, but you've got to understand what's just happened in that suburb and whether that's actually going to drive perpetual capital growth. And you really need an everlasting imbalance between supply and demand to be able to enjoy perpetual capital growth.
Now, one of the other things I've seen you write about recently is some common traits of successful investors. And I think that goes to what we were saying a moment ago, because people are going out there buying, and in some ways they're speculating. They think they're investing, but they're saying, no, this is going to be the next hotspot, or this area hasn't done well for a while, so now it's its turn. Doesn't work that way. On the other hand, successful investors, they concentrate on two particular things. They look a bit about risk and they focus on quality. Would you like to talk a bit about that, Stuart?
Yeah, I think it's really important, Michael, because I think in the main, you know, over my a couple of decades of experience, I say in the main, people just focus on return. They don't really consider risk. You know, what can go wrong? Can I lose money? What's going to impact on future investment returns to the extent that I would be unhappy in 20 years' time, for example? And I think we all like to look at returns, you know, because that's what we get excited about, and ultimately that's what's going to help us move forward. But I think the whole idea with investing is to achieve the highest return for lowest risk. And it's exactly what really experienced investors do. They try and negotiate deals and put deals together so that the downside risk is zero or close to it, and they've only got upside risk. Losing money is probably the worst thing that you can do. Losing time is probably equally as important. And so you don't want to spend 20 years in a bad investment because you'll never get that 20 years back again. So it's really about taking the lowest risk. And that's why I say I just can't understand why would I even contemplate? It doesn't make sense to me. Why would I contemplate investing in any asset if there's no evidence that it's going to achieve good returns. If there's no evidence, then all I'm doing is investing in my ego, because I'm saying I'm right and the market is wrong, and I'm going to be right, and that's what I'm going to peg my financial position to. Doesn't make sense.
Either that or they're listening to the wrong people, and people can give information that looks like evidence. So be careful who you're listening to. And if you're getting free advice, then in fact, you're the product. I know your team gives financial, accounting advice, strategic advice, and it's a fee for service, but it's an investment. I know actually all successful investors and business people I know are happy to pay for advice, while the average investor who doesn't do too well in the long run actually gets their advice free from the internet or from marketers, and it can be tainted. You've got to understand they've got ulterior motives.
In the long run, professional advice is always cheap, Michael. If I go and get some advice from a lawyer and I pay 10 grand for that advice, whether it's related to my personal or business affairs, that could save me not only a lot of stress and heartache in the future, but also a lot of money. And, it's not to say that people should just go willy-nilly start spending money on professional fees. You want to make sure you're getting the advice from someone that knows what they're talking about, someone that has plenty of experience in helping people exactly like you, someone that uses evidence-based strategies. But if you find the right person, if I give someone some advice and charge them $10,000 for that advice, without a doubt, it would be, otherwise I wouldn't choose to do it. Without a doubt, it'd be a no-brainer. For the properties that I've purchased personally, if I paid $10,000 to get that advice to purchase that property, it wouldn't influence or impact my overall returns at all. It's a I don't want to be flagrant, but literally it's a drop in the ocean.
Well, it's actually, you're either going to pay the market a learning fee, and unfortunately many people find out that in retrospect, or you treat it as an investment and you actually pay your consultants a learning fee, whether they're a buyer's agent, a property strategist, a finance strategist. Now, we both agree that finance is a really important part of the property equation, and you've written a new book, Rules of the Lending Game. You've written a number of books, and thank you, you've even mentioned me in your latest book. It came out at an interesting time because the rules of the lending game have changed, Stuart. They're changing in front of our eyes. Are the banks still friendly? Are the banks still wanting to lend?
Look, I think they're wanting to lend, and I would say of the clients that we act for, that we feel are in a good situation, get a loan approved, they're all getting approved. We're not getting declines. They certainly take longer, but that's partly because of operational issues related to the virus shutdown and so forth. I suspect that their appetite for lending may be subdued, particularly for certain sectors of the market that have been impacted by the COVID shutdown to a greater extent. And money supply into the property market is an important factor. We need to have the banks that are in the business of lending getting money out there. Now, I know the RBA has provided a funding source to the bank to promote that, which is fantastic and completely necessary. So, look, it'll be interesting to see. It's very difficult, Michael, to understand whether the bank's appetite for lending is impacted because they just don't have the operational capacity to be able to deal with higher volumes, or because they're concerned about, either the property market or the overall economy and its consequences. The good thing, though, that if we take, because those comments are really only relevant probably for this calendar year, they're not necessarily long-term projections or comments. But I think if we take a longer-term view, I think the good thing is that the banks are now firmly focused on their core business, which is really lending to residential property market. And that's really what's driven most of the banking profits over the last 3 or 4 decades, not financial service or financial advice or wealth management. So they've divested of those businesses now, and they're back to focusing on what they're doing. And so I think that that'll greatly improve over the coming years.
We know that it takes a lot longer today to get a loan approved. So I guess one of my suggestions to people listening to this who are interested in getting in property, and even if you're not ready now, or if you're waiting for the ideal time, we've already said there isn't a good ideal time, I think it's important to go to your advisors sooner rather than later, because it is going to take a lot longer. It is much harder. I've just gone through it, and I know when we chatted a while ago, you mentioned how you'd gone through it as well. I thought I was all over it, and all of a sudden, only yesterday, I got an email wanting more information. I thought, hang on, you just did a review a few months ago and everything's going well. So they're being much more careful. I think another lesson is don't go straight to the banks, because one bank isn't going to tell you what other banks have got to offer. And despite them being more the same after the Haynes Royal Commission, there are still differences in their appetites for certain industries and certain sorts of people, isn't there, Stuart?
Oh, 1,000,000%, Michael. I liken it to, probably the 70s or 80s, probably not the 80s, where you had to go and get dressed up and present yourself in the best way to the local banking manager, and then almost beg for a loan approval. Versus, in the 90s and 2000s, it was just a case of almost bringing in your wheelbarrow to the branch and they'll fill it full of cash and you walk out, no questions asked. I think it's gone back to more of that older style approach where, look, you don't have to beg for finance. Don't bother bringing in the wheelbarrow too early. You need to really, and that's why I wrote the book, because information is power, and you need to make sure that you understand the rules of the game. Different banks are going to have different rules, and they'll apply at different times. And just like playing Monopoly, you need to learn the rules, and then you need to use those rules to your advantage. The same is true with respect to lending, and it's even more true today than what it has been in the past. In the past, it probably didn't matter so much. I mean, it still played some role, but today it's critical. Today, the difference between knowing the rules and having the right advice and taking the right approach and managing your finances appropriately so that you can execute on those plans can be the difference between success or failure. Can be the difference between being able to get into the property market and buy a couple of really great quality properties to being completely locked out of the market.
So one way to start learning the rules of the game is to get the book called Rules of the Lending Game. Stuart, where do people find out about this book?
Google the name or come to Pro Solutions website. We'll include a link in the show notes, Michael, and they can use the discount code Yardney, your surname, and they'll be able to buy it for $25, and I'll pay for the postage.
Gee, well, that's pretty cheap nowadays, and I've read it, and so I find it very useful. And I know they're the basic rules, but the rules are going to keep changing. So now that you've got it and read understand it, then go and see your finance strategist about it. And why I keep using the word finance strategist is almost anyone can get you a first home loan, but I know you and your team, Stuart, as we do, actually don't just look at this deal, but it's actually part of the long-term strategy of the next one and the next one, but also the tax consequences, because having the right sort of loan structure does make a difference tax-wise.
Yeah, massively, and it's like putting a puzzle together, Michael. And there's not just one thing you need to focus or optimize. You need to focus and optimize a few different things. You need to make sure we're extending borrowing capacity well. We need to make sure we've got buffers in place. We need to reduce the cost of funding to get the lowest interest rates and fees. We need to make sure we're not compromising anything on tax benefits, and then we also need to make sure that we're positioned so that we're able to execute on future investment plans as well. And some of those things are going to compete with each other. So then it's really about kind of balancing them out and finding a strategy that's going to work. And that strategy could mean using a couple of different lenders at the moment. It could mean using one particular lender and then subsequently using a different lender again. But it's really about putting that puzzle together, because different products and different lenders are going to be appropriate at different times. And then, of course, we have to navigate the inevitable changes in credit markets and property markets and valuations, and then also personal circumstances as well. So it's not as simple as just getting a spreadsheet, comparing some interest rates and picking the lowest one. In fact, it's far from it.
Well, that's probably the least important. I know that's something a lot of people concentrate on, but actually having the money, but also buying time by having the buffers to be able to ride through some of the challenges that are happening at the moment. I don't know, the clients that you've got and we've got have actually had the facility to see through these difficult times, when maybe a year or two ago, when the loans were set up, they'd wonder, why do that? What's the trouble? That was the insurance that's been set up to see them through these times.
I often use the phrase borrow when you don't need it, and that's the best time to borrow. To proactively go and increase limits back to 80% of current valuation of your properties, even if you have zero intention, even if you're against investing in the future, you just never know what's around the corner. And the more access you have to credit, the stronger your position actually is. It sounds counterintuitive because borrowing more seems risky. But obviously, if we're borrowing more and then we're just wasting the money, that's stupid. But if we're borrowing more and just leaving that money in reserve for a rainy day, or if something happens, or a great investment opportunity presents, or our circumstances change and our borrowing capacity reduces, it's always going to prove a wise move. And it's something that I do personally. I know it's something you do as well, Michael. And it's just common sense. And again, a good advisor is going to sort of take you through that process. And I think that's one thing that you're going to get from advice. The knowledge is one thing. You can read a book. You and I can read a book on surgery, for example, but we just don't have the experience to obviously operate on ourselves. And the same sort of thing when it comes to property and financial advice, that we can educate our clients and help them avoid the mistakes that we've seen over the many decades that we've been in business.
Well, 30 years ago, I learned this lesson almost the hard way, as I saw during the recession we had last time. A number of my friends, two friends and business colleagues, go bankrupt because of what's going on. So I came into this downturn with buffers. I didn't know what I was going to use them for. I didn't know how bad business was going to be or not. Unfortunately, it hasn't been that bad. I didn't know how many of my tenants wouldn't pay rent for a period of time, but it gave me the coverage, the insurance to be able to get through all this, and we're going to get out the other side very safely. So having those sort of lessons behind you that only you and I have learned from years of experience are important. I think the other really important lesson is what we started this chat with, that it's not timing. And if you own the right asset, it's not even how much you pay that's important. It's owning the best asset that you can afford. And since your money's going to run out before the opportunities are, because you're only going to ever be able to own 2, 3, 4, 5 properties, own the best ones. Maybe we should just finish with that quick discussion, because only recently somebody said, I've got $1 million to borrow. Should I buy 2 $500,000 properties or one other asset, one good one? And really the answer is own the best asset you can.
Allocation of a scarce resource. That's what it really comes down to, Michael. And I guess if we were told we only had 2 months to live, we would be very, very careful about where we spent our time. And, if I said to you, you only have $1 million to borrow in your entire life, if you had good advice, you would be very diligent about how you allocated that $1 million worth of borrowing capacity. And so we all have the limit, either that's been dictated by the banks or by our financial circumstances or appetite for risk. But we all have our limit, no matter who we are. And it's really then about allocating the scarce resource. And you're right, I would much rather own one fantastic pink diamond property than 10 very average properties. It's a really important point to try and get across and try and educate clients about, because quite often someone will say to me, oh, look, I had this property, bought it 10 years ago. Look, it's paying for itself. It's washing its own face. The rental income pays for the loan. So why should I sell it? Well, it's the opportunity cost. You're allocating a scarce resource, which is your borrowing capacity, towards an asset that's actually not giving or maximizing your return. Why would you do that? Not always, but in a lot of circumstances, they're better off divesting of that asset, putting in a much better quality asset. In the short term, that feels like a bit of a painful experience, but in 20 years' time, they'll look back and go, well, that was a no-brainer.
Well, we have a very similar philosophy. So we have spreadsheets, and I know you do for your clients as well, where we do the numbers and sums. And if it's going to take 20 years to get the return back of the capital gains tax you pay and the borrowing and selling costs, no, you wouldn't do it. But if after 2 or 3 years you can actually show that, you're going to step back, take 2 steps back to move 3 steps forward, then it's worthwhile. So again, evidence-based information is important. So maybe to summarize it, when you're going to buy an investment property, there really are 3 things you're playing with. There's your budget, and that's, as we just said a moment ago, not determined by you, but determined by the banks. There's location, and you've already suggested, Stuart, that that's critical, and it makes up the bulk of the performance of your property, maybe even up to 80% of the performance of your property. And the third variable is the property itself. And then, as you said, you want to get one that's an investment grade, not an investment class property, one that's scarce, one that's got the attributes we spoke about that are in particularly high demand by a wide range of more affluent people who are always there's going to be a number of people standing in line to get that sort of property. That's going to get you through these times well. Stuart, thank you for explaining those thoughts to us. There'll be the links to your book and to the numbers and figures of your blog in the show notes. Look forward to catching up with you again real soon.
Thanks, Michael. It's been fun.
Well, there was a lot of information coming out of my chat with Stuart a moment ago, and one of the underlying themes was buying an investment-grade asset. And while price isn't anywhere near as important as some people think, of course you don't want to overpay either. And currently our property markets are in a state of flux, and correct property selection is even more important than ever, and only certain segments of the market are going to outperform moving forward. So why try and do it on your own when there's so many bits to the puzzle? Why not get the independent team of property strategists at Metropole, my team, to help level the playing field for you? We help our clients grow, protect and pass on their wealth. We give them direction in these uncertain times. Go to metropole.com.au and you'll find out about our range of services. We give strategic property advice by building a strategic property plan. We help a buyer's agency that's been involved in over $3.5 billion worth of property transactions over the years. Wealth advisory, property management, property renovations, property development. There's lots of ways we can help. But the first step is to come and ask. You don't even have to come today because we do it virtually with what's happening in the world. Go to metropole.com.au or give us a call on 1300 Metropole, and I'd love my team and me to be part of your wealth creation journey.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I'd like to spend a couple of minutes talking to you about failure and why some people overrate failure, because the bottom line is we're all going to have successes in some areas and failures in others. And hey, I'm a real success at failure. So I got it both ways because I've had more than my share of failures. And if you try to become successful, whether it's in business, in personal relationships, in property investment, things won't always go right. So don't let it get you down, because failing is never permanent. I know you got that sinking feeling in the tummy, but it won't last forever. So the best way is to reflect on your failures and focus on the lessons that you've learned and the person you're going to become, rather than spending your time trying to avoid failure. Because if you avoid failure, you're never going to try things, and that's going to stop you being successful. So the less time you spend on the rejection, the faster you're going to grow. I think another important factor is to own up to your failures. The moment you openly talk about the things that make you vulnerable, they no longer have power over you. People will appreciate your honesty because everyone knows what it's like when they've had setbacks, when you make mistakes. In fact, they're going to respect you for owning up to your problems and embracing your failures. You become stronger in their eyes, but you also become stronger in your own eyes. Now, an important message that's come through many of my mindset messages is that the world won't change unless you do. Remember, the world owes you nothing. It was here first. So you can't blame your shortfalls that are happening in your life or the people around you or your past decisions on things that are happening to you at the present. It's not the event that defines you. It's how you choose to react to it. So forget what others say. They're going to judge you anyway. If you want the world to change, you have to change first. You've got to change the way you think. Remember, your outside world is a reflection of your inner world. Your thoughts lead to your feelings lead to your actions lead to your results. Now, Steve Jobs once said it cleverly. He said, if you don't love it, you'll fail. So my question to you is, how badly do you want it, whatever it is that you're after? Remember the story about Thomas Edison. He made 1,000 or so unsuccessful attempts at inventing the light bulb. But from his perspective, he didn't fail 1,000 times. The light bulb was the invention with 1,000 steps to get there. So my question to you is, what are you after in your life that you're now going to have to just keep doing that little step by step, failing sometimes, getting a bit closer till you get there? And remember, when you do fail, and you will, just because you fail doesn't mean you're a failure. Never let failure deteriorate your self-worth. If your head hurts, you don't say, I'm a headache. You say, I have a headache. So failure is nothing more or less than an event. Don't personalize it. And remember that failure is part of the process to success. The fastest way to become successful is to double your failure rate. Successful people have failed more times than a beginner has even tried. So, the bottom line from today's message to you is, if you want to succeed, fail faster. I hope you learned a few things in today's show, and if you got some benefit and you know somebody else who'd also like to become more successful with regard to property, investment, other areas of success, why not tell somebody about the Michael Yardney podcast? And please help me in spreading the word and helping as many people as possible become financially independent. If you want to tell the world about it, leave a review on Apple Podcasts or Spotify or Google Play, wherever you listen to this. And if I read it out, as I'm about to for Rhubarb Rhino, and you email me, michael@metropole.com.au, I'll say thank you by gifting you one of my books. And Rhubarb Rhino left a bit of a puzzle, so I'm not going to go into the whole lot other than him saying a 5-star review and amazing work, Michael. But he said starting from scratch, he left a puzzle saying starting from scratch with your 25-year-old body, income and savings, if you went back to the past with all your current experience, how confident are you that in the next 25 years you'd outperform the returns of the last 25 years? Well, Rhubarb Rhino, that's a good question. And the answer is, if you haven't learned from your successes and your failures, it would be a real shame, a real pity. So it's important to learn from the right sort of people. And as we said already in today's show, learn from your mistakes. So thank you for leaving a puzzle rather than a review, other than the fact that you said it's amazing work. So very much appreciated. I'll be back again real soon, twice a week for the Michael Yardney podcast. In between, you can keep contact with me on social media. I'll find out about you if you make contact with me on social media, and you'll find out a bit more about what I'm up to. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?